All right, let's jump right into this. Welcome to The Explainer. Today we're unpacking one of the absolute most fascinating phenomena in modern finance. I'm talking about the incredible accumulation of massive, staggering wealth right alongside what are, frankly, microscopic tax bills. We constantly see headlines about ultra-wealthy individuals paying a tiny fraction of what an everyday worker pays. But how exactly does the actual machinery behind that work? Well, today we're setting aside all the rhetoric to do a completely impartial, mechanical breakdown of the legal tax frameworks that make this entirely possible. And this brings us to the central question we really have to ask. Because it feels deeply counterintuitive, right? If you want to buy a yacht, fund a massive new business, or just live a lavish lifestyle, you need cash. But the moment you sell a highly valuable asset to get that cash, boom, you trigger a massive tax event. So how do billionaires actually extract and spend their wealth without triggering those taxes? So here's our roadmap for today. First, defining the strategy. Second, the sheer scale of the borrowing. Third, the realization principle. And finally, options for tax reform. Let's get to it. Section 1. Defining buy, borrow, die. Let's unpack exactly what this catchy framework is and where the term actually came from. Now, what's wild about buy, borrow, die is that it isn't some shady, secret backroom deal passed around in whispers. It's literally an academic concept. It was coined back in the mid-1990s by USC law professor Edward McCaffrey. He created the phrase just to help his law students understand the fundamental mechanics and, well, the loopholes of the US tax code. It is a completely legal, highly structured approach to wealth management. Okay, so here's how the whole shebang works in 3 pretty simple steps. Step 1, you buy assets that will grow in value over time. Think stocks, real estate, private businesses. Step 2, instead of selling those assets when you need cash, you just borrow against them. Because loan proceeds aren't taxable income, you get completely tax-free liquidity. And finally, step 3, the die phase. This relies on a tax code provision where assets passed to heirs get a stepped-up basis to their current market value, which permanently wipes out the capital gains tax on all of that lifetime appreciation. But let's put some actual numbers to this, because the concrete math is where it really clicks. Imagine you've got a $5 million stock portfolio, and you need $3 million in cash. If you sell $3 million worth of stock, you get hit with a combined capital gains and net investment income tax of 23.8%. That is roughly $571,000 going straight to the IRS. But if you take out a portfolio line of credit at, let's say, 6% interest, it only costs you about $180,000 a year. That's an absolute bargain. Plus, and this is key, your full $5 million portfolio stays totally intact and continues to grow, which can completely offset the cost of that interest. Moving right along to Section 2, the scale of borrowing. Now that we know the basic mechanics, let's see how this translates into real-world macroeconomic numbers. A few years back, there was a massive data leak to ProPublica, and it revealed a truly staggering statistic. Analysts looked at the 25 richest Americans over a 5-year period. They found that their collective wealth grew by $401 billion. Yet they paid only $13.6 billion in federal income taxes. When you divide the taxes paid by the total wealth accrued, you get a true tax rate of just 3.4%. I mean, compare that to the maximum ordinary income tax rates of nearly 40% during that exact same period. And you can really see how this borrowing scales up with extreme wealth by looking at someone highly visible like Elon Musk, based on public SEC filings. Back in 2011, Musk pledged 4.5 million Tesla shares as collateral for personal debt. Fast forward to August 2021, and that number had soared to 88.3 million shares pledged. To put that in perspective, the value of that collateral in 2021 was an astronomical $61.9 billion. It's a perfect illustration of how billionaires can convert asset appreciation into cold, hard cash on a massive scale, all without ever triggering a sale. Section 3, the realization principle. To really understand why this massive scale of borrowing is perfectly legal, we have to zoom out and look at the legal friction at the absolute heart of the US tax system. It all comes down to this thing called the realization principle. Under current tax law, an increase in your wealth isn't taxed until it is realized, meaning you actually have to sell or exchange the asset. Just watching your stock portfolio go up in value on paper, that's an unrealized gain. And here is the kicker. Borrowing money is not considered a realization event because every single dollar you borrow is offset by a liability, your obligation to eventually pay it back. The law says there is no net accession to wealth. Now, as you can probably imagine, the political polarization around taxing this unrealized wealth is intense.
On one side, you've got figures like Senator Bernie Sanders arguing for a tax on extreme wealth to fix inequality. On the flip side, figures like Senator Mitch McConnell argue that taxing unrealized gains basically means taxing money people haven't even made yet. But listen, for this explainer, we are looking strictly past the politics. We want to examine the underlying constitutional law that makes changing the system so incredibly difficult.
The actual constitutional debate here goes way back to the 1800s, to cases like Eisner v. Mockingbird. It's like a giant constitutional puzzle. The U.S. Constitution essentially splits taxes into two main buckets. Direct taxes are subject to the rule of apportionment, which means they have to be divided among the states based on population, making them practically impossible to implement. Excise taxes, however, are subject to the much simpler rule of uniformity. The legal friction we face today is that a direct tax on wealth itself, or a mark-to-market tax on unrealized gains, might very well be ruled an unconstitutional direct tax by the Supreme Court.
So, what's fascinating here is that legal scholars are actively proposing constitutional workarounds. And honestly, it feels like a real light bulb moment. An article in the Buffalo Law Review argues that, hey, maybe we don't actually need a constitutionally risky wealth tax. Instead, Congress could simply amend the tax code to define the act of extracting cash via a loan when it's secured by appreciated assets as an act of realization. Think about it. By pulling out cash that you can use for literally anything, you've monetized the wealth. If borrowing becomes a realization event, it falls neatly under the standard income tax, completely sidestepping the whole direct tax debate.
Which brings us to Section 4, Options for Tax Reform. With the mechanics and the legal foundation established, let's explore the actual federal policy proposals aimed at addressing this. To really measure the problem, the folks at the Budget Lab developed a model. They found that under current law, borrowing gives wealthy individuals a 12 percentage point advantage over simply selling their assets. This creates a severe horizontal inequity in the system. Basically, it means two taxpayers with the exact same economic ability to pay are treated entirely differently, simply because one has access to millions in portfolio lines of credit, and the other, like most of us, relies on a standard paycheck. So there are currently three neutral policy options on the table aimed at fixing that 12% advantage. Option 1 is a deemed realization tax, which treats new loans against appreciated assets as a taxable event, projected to raise about $102 billion over 10 years. Option 2 is a flat 10% withholding tax on loan proceeds that you later credit against your capital gains, raising around $147 billion. And option 3 is a 0.5% annual excise tax on the loan balance itself, raising $130 billion. Now, each one of these has different administrative hurdles for sure, but they all specifically target the borrow phase of the strategy.
But here is the big takeaway you really need to understand. As we head into 2026, this strategy is actually gaining steam. A recent piece of legislation, the One Big Beautiful Bill Act, permanently increased the federal estate tax exemption to $15 million per individual. Because of this, the die portion of Buy, Borrow, Die is practically supercharged. It ensures that up to $30 million for a married couple can pass completely tax-free via the stepped-up basis, erasing all that unrealized capital gain permanently.
So as we wrap up, we're left with a massive question. Will these targeted reforms ever realistically close this loop? Even if a deemed realizations tax on borrowing is passed, will it practically balance IRS administration and economic equity? Or will the ultra-wealthy simply adapt, pivot, and find the next iteration of Buy, Borrow, Die? It seems like the mechanics of wealth always evolve one step ahead of the laws trying to govern them. Keep questioning the machinery behind the headlines, and thanks for joining me for this explainer.